Hello, everyone, and welcome to How to Spot Big Upcoming Market Moves. Today we have Jesse Colombo with us from Cyber Trading University, and this is the second time that Jesse is with us. So we want to give Jesse a warm welcome. He is an economic analyst and forex trading instructor with Cyber Trading University. And today he's going to speak to us about a topic that is very timely because we have had some huge market moves of late, in fact, for a very long time now. And Jesse will teach you how volatility works, all about the volatility cycle and how to find the best time to trade and how to avoid getting caught in chop. So, without further ado, I'd like to turn it over to Jesse, and I'm sure it'll be a great presentation today.
Good afternoon, ladies and gentlemen. Thank you so much for that introduction, Jody. Looking forward to teaching you this presentation. So it's called How to Spot Big Upcoming Market Moves. I'm just going to start with a few slides showing some of my methodologies that I use for analyzing the markets, and then if I have time, I want to do a market analysis, just looking at some of the major forex patterns that I'm seeing right now, and we're definitely at an important crossroads with the U.S. dollar and other correlated currencies, which I'll discuss in this presentation. So first, want to discuss the risk disclaimer. As you know, there's a high degree of risk involved in all forms of trading, whether it's forex, futures, stocks, or bonds. So Cyber Trading University and myself, we're not recommending that you place any trades or trade, period. We're not giving investment advice. It's for educational purposes only. So just want to discuss my background really quickly. I'm Jesse Colombo. I'm an independent economic analyst and researcher who was recognized by the London Times in 2008 for warning about the global financial crisis starting in early 2004. And I built a popular website called stockmarketcrash.net when I was a university student to actually warn about what I saw as far as the growing housing and credit bubble. And then when it popped, that's when I became recognized for basically warning about it in 2008. And then in the last 2-3 years, I became known for warning about dangerous post-2009 economic bubbles that are developing around the world, from China to commodities, which is a bubble that popped, oil, which is part of the commodities bubble, certain segments of tech, including hot tech startups, stocks, etc. So what's happening is central banks are basically have flooded the world with liquidity, and it reinflated the bubbles that tried to pop back in 2008. So it became essentially known for this whole topic, and Forbes magazine contacted me a year and a half ago and asked me if I'd like to write a column for them, and I've been doing that ever since. And I'm a social media personality who has quite a big following. I discuss these bubbles as well as their trading implications, and that's something I also write about on Forbes.com. And I recently partnered with Cyber Trading University to teach forex and futures trading. So just want to discuss the crux of the methodology that I use for analyzing the forex and futures markets. There's so many different ways of going about it, but this is one of the most effective ways, and it's called intermarket analysis. And I believe everyone needs to be aware of it. Most people, or many people in the markets, are not aware of it as much as they should be. And it's basically when you use one financial market to predict moves in another related market. And it was first expounded upon in detail by technical analyst John Murphy. I'm a big fan of his books. He's actually written books about intermarket technical analysis back in the 80s, and I recommend checking them out. You can buy them used on Amazon inexpensively, and I think it's a great cornerstone of your trading library. And basically, intermarket analysis uses established relationships and correlations among currencies, commodities, bonds, and equities to basically find signals in the different markets. And what you do is you look for chart patterns or other forms of signals in one market because it often has similar implications for other correlated markets. I'm going to show you the charts of how to go about that. But first, wanted to make you aware of the most important intermarket relationships in the first place, and not that many people are aware of it, surprisingly. The number one most important by far is the relationship between the US dollar and other currencies, and that's an inverse relationship. So when the US dollar goes up, other currencies from the euro to the Australian dollar to the British pound drop. It's not surprising because they're priced in US dollars. But so are commodities. And that's one of the major reasons why we had the oil bust that started just about a year ago, back last June, was because of the surge of the US dollar. Because the Fed was tapering, and there were discussions about upcoming Fed fund rate hikes, which we're still obviously trying to figure out the timing of. So that represented a tightening on the part of the Fed, U.S. monetary policy, which boosted the dollar, and also speculation about the then upcoming QE program that Europe was going to launch, the ECB was going to launch, which they end up launching just a few months ago, and they're printing 60 billion euros per month, so that weakens the euro. So that simultaneous tightening of U.S. policy and loosening of European policy caused the U.S. dollar to surge. And I wrote about that back in June 2014, pretty much a few weeks away from the top. I warned about this big oil bust and commodities bust. So it's that inverse relationship. And now you'll notice over the past month or so, the U.S., or last month and a half, the U.S. dollar has been pulling back. It's been weak. And sure enough, oil's been rebounding, along with many other commodities. So just be aware of that relationship. The other relationship is, and it's a traditional relationship, where it's basically the relationship between commodities and bonds. And it's an inverse relationship because rising commodities prices tends to be a proxy for rising inflation. It tends to lead the CPI. And inflation hurts bonds. Bond holders are receiving a fixed income stream. So when inflation is running hot, it erodes the value of that fixed income stream. So that's why when commodities experience a bull market, bonds fall and interest rates rise, and vice versa. So the commodities bust of the past year helped to actually boost bonds and reduce interest rates. I'm going to be showing you charts. Do not worry. I just wanted you to be aware of these concepts. The other traditional relationship, and this has not held up as well in the QE era of the last 7 years, but it's an important financial and economic principle just to be aware of. But in general, stock bull markets lead to bond weakness and higher interest rates, and vice versa. So there's an inverse relationship between bonds and stocks. And the reason why is because in a strong bull market, people want to take greater risks. And that typically occurs also when inflation is ticking up, which is bad for bonds. So people basically shun less risky assets like bonds, and they remove their capital, and they basically funnel it into equities. And when there's an equities bear market or a recession, bonds do well because it's due to flight to safety capital flows. And rising bonds then lead to lower interest rates, and we experience lower interest rates in times of economic weakness. So there's that inverse relationship. And then the other relationship is commodities versus commodity currencies. So an example of commodity currencies are the Canadian dollar, Australian dollar, New Zealand dollar, and there's that positive correlation because when commodities prices go up, it boosts those currencies. When they drop, it hurts those currencies. So what I typically do as a starting point when analyzing both forex and commodity futures is the starting point is watch the U.S. dollar index. Very often it's the $ DXY, but it depends on your platform. That's a typical starting point that I watch, and I perform a technical analysis on it. For example, if I see a bullish signal in a U.S. dollar index, then that makes me take a bearish bias on non-U.S. currencies and commodities. And some of these slides are from a few months ago just because I zoomed in because that was one of the most exciting periods to be a forex trader and a commodities trader, just because that was where we had this epic dollar surge and the plunge in commodities. So once I'm done with these slides, I hope to get around to showing you what's happening currently and basically applying this knowledge that I'm discussing today. So just watch the US dollar index, and you'll notice that that bull market that began back last July correlated with the bust in commodities. So right now, this chart just shows the Dow Jones-Ubs Commodities Index. Just think of this index as being similar to the Dow or the S&P 500, but for commodities. So what it does is it aggregates or averages the most important, most liquid, heavily used commodities, from oil to wheat to corn to copper, and basically makes a basket just so it can be a representative proxy for overall commodities prices. And you'll notice that that commodities plunge corresponded with the start of the dollar rally last summer. And back to what I was saying before about that relationship, the inverse relationship between commodities and bonds, you can see the commodities bust boosted bonds, because falling commodities prices tends to have deflationary implications, and bonds thrive in that type of environment. Because in a deflationary environment or a disinflationary environment where inflation is dropping, investors who receive a fixed income, whether it's an annuity or it's dividends or it's bonds, basically earn a higher real return because inflation is not eroding the value of those payments. So that's why the bond market reacts very quickly and very nimbly to commodities prices. And you can see commodities currencies were slammed. You can see this is the Canadian dollar, and this is the Australian dollar. They were absolutely slammed because of the commodities bust. So in the case of Canada, it was a double whammy, because not only was the US dollar rallying, and in this case, I'm showing you Canadian dollar futures rather than US dollar Canadian dollar, just so it's a little more intuitive that when this chart falls, it means the Canadian dollar itself is falling. And it was double whammy because the dollar itself, US dollar was rallying, and oil was plunging, and oil is one of Canada's most important exports. And it's very essential to Canada's economy. They have the oil sands boom over the last few years. So when you have falling oil prices, it just hurts the Canadian dollar. In Australia's case, it's also another economy and currency that's highly levered to commodities prices. But in this case, iron ore plays the role that crude oil played for Canada. So Australia is a very important exporter of iron ore to China. So China's economic boom has led to surging demand for iron ore, but in recent years that demand has softened as China's economy has continued to slow. And iron ore prices themselves, even though I don't have a chart here, have plunged. And actually they've been rallying in the past month or so. They've been rebounding a bit, and that's actually been boosting the Australian dollar, as I'll show you when I do the live chart analysis. So here's how you apply into market technical analysis. It's quite simple, but very few people are aware of it. You identify correlated leading markets first. For example, commodities and the US dollar, or the US dollar index, tends to lead commodity currencies like the Australian and Canadian dollars. Next, you want to find chart patterns or other actionable technical information in those leading markets. For example, a bearish head and shoulders pattern in commodities creates a bearish bias for both the Australian dollar and Canadian dollar. And finally, you want to look for technical confirmation in the lagging market. For example, you want to look for a bearish confirmation in the Australian dollar and Canadian dollar after the bearish commodity signal was given. So a key principle in all my analyses is looking for confirmation. You want to see multiple markets telling you the same thing, because it reduces the probability of there being a false move. And that's one of traders' worst enemies, is these false moves, false breakouts. algo head fakes, bull traps, bear traps. They all have different names, but really they're the same concept. It's where you get into a trade and you get whipsawed. So I found that looking at multiple markets that are correlated and receiving the confirmation among these different markets helps to basically increase or boost the signal to noise ratio. So here's an example. This is from last summer. You can see the U.S. dollar index was showing many bullish signs. We kept on receiving bullish signals over and over. For example, this was pretty much all of last summer, last spring. You could see that the U.S. dollar was struggling underneath that 81, that resistance level right underneath 81. And once it broke right above 81 in August 2014, you can see it formed a sideways trading range. But it was still above that $81 support. And then once it broke above there, that was another bullish confirmation. And that was basically a sign that there's some real technical strength in the U.S. dollar and that your bias should be long rather than short. And then you can see there were several pullbacks along the way this past fall and winter where that basically they formed a rising uptrend line, which is a support. And I actually showed these in real time to my followers as they were forming. Just connect the lines, and basically it respected that uptrend line quite well. And as I'll show you in the live analysis, it's still basically trading in a trading range. It formed a trading range where you have that same support line, which is actually coming into play today, which I'll show you. And you have another line that was forming right on top that was basically enveloping the action as almost like as the resistance line. You can see was in a confirmed uptrend. And those gave many bullish signals in the U.S. dollar. And those are bearish signals for commodities and non-U.S. currencies. So what's interesting is last summer, there was another bearish pattern that actually formed in the Dow Jones Commodities Index. And that was a head and shoulders pattern. It's a very clear, cut and dried formation. And you can see that neckline is right around 132. And you can see the left shoulder, right shoulder, the head that formed in early May, pretty much just a year ago. And then once it broke below that support line, that neckline, in early July 2014, that was a sign that there was a major breakdown in commodities. So what's interesting is that that coincided with the bullish action that was occurring in the U.S. dollar. And you can see there were several bearish signals that were given all the way down in commodities. So you can see back in October, November 2014, right around 116, a support level formed where you see this confluence of lows or lower candle wicks, as people who are a fan of candlestick charting call them. And then once it broke below there was another bearish sign. So next you look for confirmation in lagging markets. So I was saying that commodity currencies are an example of a lagging market. And you can see the Canadian dollar's top actually occurred at the same time as the sell signal in commodities. So this top occurred back in late June, early July 2014. That was the top before the big plunge. And it occurred right at the same time as the sell signal in commodities, right over here in early July. And believe it or not, a bearish head and shoulders actually formed as well in the Canadian dollar. And it's the Canadian dollar futures I'm showing you right there. And you can see 0.91 was that neckline or that support level. So once that broke down, that was the additional bearish confirmation. You can see the same thing in the Australian dollar. It formed a trading range. I didn't show the resistance level up here, but if you can just visualize, it was a trading range between April and August 2014. And 0.92 versus the U.S. dollar was the support level. So what's interesting is that bearish confirmation, that sell confirmation, was given in mid-September 2014 when it broke below 0.92. So what's very notable here is that that sell signal actually occurred 2 months after the sell signal in commodities. And I'm going to go back a few slides. So you can see the commodities bearish signal, the breakdown of this bearish head and shoulders was given in early July 2014. And 2 months later, the Australian dollar sell signal was given. So it's very interesting. It gives you lead time where you can start looking for those types of setups. I also like to find confirming chart patterns. And this is an example that I showed back. I showed this on my Forbes.com column. I showed how bearish pennant patterns, which look like small triangles, they are a continuation pattern. I showed that they were forming in crude oil. And at this time, traders and financial journalists and economists did not believe that oil had further to drop. I'm talking back when oil was at 70. They thought that was the bottom. If you Google, there's a lot of articles about, is this the bottom? I remember on CNBC, they were all excited. Is this the time to go long oil stocks? But when I saw that first bearish pennant in early December, right, just under 70, I was very concerned. I said, uh-oh, if this breaks down, this is likely to be a continuation pattern, and who knows how low it can go. And sure enough, it dropped another almost $12, $13 or so. And then another one formed in not even a month later in late December. And that broke down and led to further bearish action. So you'll notice that similar patterns actually formed in the Canadian dollar right around the same time. And you can see that's no coincidence. That's not a coincidence. You can see it formed that. This is the Canadian dollar futures. You can see in early December formed that triangle, broke down at the same time that crude oil broke down. So it's nice if you're interested in going short or trading any one of these, whether it was crude oil or Canadian dollar. It was nice to get that confirmation from another correlated market. And the same thing happened late December too. So now I'm going to do my live chart analysis. Just want to show you what I'm currently looking at. Lots of interesting action is occurring, and we're at a key turning point. So let me just get my live charts up 1 second. Let me find the US dollar. Okay. So let me just draw my lines. Actually, let me go on weekly. So I was saying earlier that the US dollar index was in a strong uptrend. And I was showing that rising support line, that uptrend line. And that pretty much guided the US dollar throughout this entire rally. And it also appears that it was trading in a channel, or what seems like a channel. You can see almost, if you connect, I don't know if I did that 100% perfectly, but if you connect the highs of the dollar in the past year, you can see it pretty much rose in the form of a channel. So you can see in the past few weeks that broke down. This became a crowded trade. And you can actually see that in, I'm going to show you this right now, in the futures. If you look at the US dollar index futures, you can see the large traders who are typically considered to be the dumb money at major market turning points became excessively long the US dollar. They're in red right over there. And it just became a crowded trade where pretty much all the momentum traders were going long the US dollar and short everything that was not the dollar. So whenever you have that type of imbalance, there's a very good chance of some sort of a violent trend reversal, even if it's temporary, just to shake out the trend followers, the dumb money. And you can see the commercial hedgers in this US dollar index futures market still actually have a very large short position, which I do find notable. But I'll get into that a little more later. Just going to go back to the chart analysis of the US dollar. So this is the first concerning sign, just to see that breakdown right over here. Next, I was watching important support levels. So one of the support levels that I was watching was the key psychological or technical level that was formed by the highs that we saw in late January, early February, as well as the lows that we saw back here in mid-March. So you can see that was an important level. And in the last 2 days, the U.S. dollar index just sliced right below that level. So that's one concerning sign. The next level that I'm watching for final confirmation, just because it's still not 100% confirmed, is this level that was reached right over here. It's pretty much the lows of this trading range that we saw back in February and March. So you can see after Janet Yellen's testimony today that the U.S. dollar index actually bounced right off that support, just showing that there really is something there. So essentially what happened was Yellen's testimony was a little bit more hawkish than market participants expected. And early on, the dollar tried to break below that level, but has rebounded, recovered a bit from there. So now I'm watching what happens at this level. Are we going to see an actual bounce from here, maybe try to see if it heads back to the prior highs, or if it's going to give another sell or bearish confirmation if it breaks below that support. If it does, that would have bullish implications for non-U.S. currencies and commodities. So I'm watching this very closely. So I'm just showing you, this is my starting point with the U.S. dollar index. Now I'm going to head on to other markets. But I also look, in addition to the U.S. dollar, I watch the euro versus U.S. dollar because it has such a heavy weighting in the U.S. dollar index. So I look at key levels in the euro as well, just to give me further confirmation. So, and I'm going to show you the positioning of traders in the euro. You'll notice that the dumb money or the large traders have a very large short position of 200,000 net short contracts. That's one of the larger positions, actually the largest, I believe, they've had in the past half decade or more. So you'll notice, whenever those large traders build a significantly large short position, they tend to be wrong. And this actually happened in the summer of 2012 when there was, again, fears of Greece leaving or Eurozone breakup. You can see that they were the most bearish pretty much right at the bottom. And they did the same thing back in spring 2010. And very often these extreme bearish positions form or result from fears about a breakup in the Eurozone or a Greek exit, which still after half a decade has not happened yet. And you'll notice the smart money in green, they're the commercial hedgers, do the opposite of the large traders, and they actually built up large long positions, almost pretty much inverse of the large traders, and they did that back in mid-2010, right before the huge surge. Same thing in mid-2012, and they've been doing that for the past 7-8 months. So it's not too surprising to see some sort of a rebound in the euro. So now in the shorter term, I'm just going to show you what I'm watching. I was watching the 1.11 resistance level. That's the low that we saw back on January 21st and 25th. And I'm also watching 1.10. And that's a major round number. Round numbers tend to be support resistance levels. And you can see that pretty much was a resistance level for much of March. So you can see the euro struggled to break above there, long upper wicks. So support and resistance levels are rarely a single number. They tend to be a zone. And that's because traders place their stops above and below key chart areas or psychological levels. So you can see this level is basically a zone between 1.10 and 1.11. So today you can see the euro versus U.S. dollar actually rose above 1.1. So that's first bullish confirmation. But I want to see a further bullish confirmation in a form of a solid or convincing close above 1.11. So we're actually above there slightly, but it's not convincing enough just yet. So I'm going to be watching over the next 24 hours if there's a convincing follow-through. So it's very interesting to see the euro is basically cleared that resistance zone. And as I was saying, I want to see if the U.S. dollar index itself can break below that support that was formed back in February, and that would give another bearish confirmation for the U.S. dollar and a bullish confirmation for the euro. And the euro tends to be positively correlated with commodities. There are many trading algorithms out there now that tie or arbitrage the euro versus commodities. It's not a 100% correlation, but there's a general tendency where sometimes you'll see a surge in the euro will correspond with a surge in oil or gold. And that's because the euro trades inversely with the U.S. dollar index and the U.S. dollar itself. So I'm just watching this key level 1.11. Just want to show you what I'm watching in the U.S. dollar, Canadian dollar. So I've been showing this to the people in our cyber group room at Cyber Trading University. I've been showing how the U.S. dollar, Canadian dollar currency pair was trading in a range between 1.235 and 1.28, right in a range. And it actually broke down a couple weeks ago, because of the rebounding oil prices as well as the breakdown of the U.S. dollar itself. So I want to see where this heads, so that's why I'm watching oil, which I'm going to show you next. This is West Texas Intermediate crude oil. It's the U.S. oil benchmark. So I was watching, and I was actually publishing quite a few months, this trading range in oil. And you can see it was a range between $54 per barrel, that was the resistance, and $44 per barrel, which is the support. So a few weeks ago, it rose right above that $54 resistance, and now it looks like it's forming a possible pennant pattern. And if you recall from my presentation, I show those pennants that form to the downside in oil. See, this chart doesn't show it perfectly, but if you look at other charts, but this was basically a pennant right over here. So now I'm watching to see if this is going to be a bullish follow-through in this pennant. It really needs to clear the high of this pennant, and ideally I'd like to see it break above the key psychological level at 60 for further confirmation. But if there's further bullish action here, that's likely to bring the Canadian dollar up with it, along with energy stocks and other commodities. But I'm also watching for further confirmation of this. I want to see if the U.S. dollar itself is going to experience a further breakdown below that support that was formed in February, because then that would give a further boost to oil. So we're really at a critical juncture here in the forex and futures market, which is why it's very appropriate I'm doing this webinar. Next, I want to show you the dollar-yen, show you what I've been watching. So you can see over the past few years, as you know, the U.S. dollar has strengthened and the yen has weakened. That's because of Japan's Abenomics program, which is basically similar to the U.S.'s QE program. And for the past few months, the dollar-yen has actually consolidated. So I'm watching this possible wedge pattern right over here. And when there's a final breakout or breakdown, I believe there's going to be a very big move. And it's not confirmed either way, and I'm not predicting which way it's going to break. I'm just waiting for confirmation. But there's been some talk about another possible wave of Japan's Abenomics program, where basically there's Japan's economy continues to stagnate. It's really a basket case. They've got so much debt. They've got demographic issues, excessive aging of the populace, which just leads to a stagnant economy. So no matter how much money they print, I don't believe it's going to create a sustainable recovery. So there's been some discussion that there could be another wave of easing very soon. And if that's the case, then I wouldn't be surprised to see the dollar-yen break above this level and then keep rising, maybe even make a move similar to what it made this past fall. However, if there's a breakdown, then obviously that would be a bearish signal. But I'm more so interested in the upside thesis, just because I am concerned about the yen in the longer run, just because I don't believe that you can print billions and actually trillions of dollars worth of currency without a significant weakening. And I know we've seen some of that already, but there's some reason to believe that Bank of Japan will pretty much not be able to stop anytime soon, and that could lead to even more weakness. There are even some analysts out there who believe that there's going to be a mass sell-off of Japanese government bonds, and that either their government's going to default because they have a debt to GDP ratio of about 200%, whereas the U.S. is about 100%, and that because they have so much debt that Bank of Japan really has no other choice but to keep on printing in order to keep interest rates at low levels. So some theorists or economists actually believe that the dollar-yen could actually hit 400, which would be a multiple of what we're seeing here. So that's why I'm interested in this thesis. If there is a breakout, it could be an interesting long. Of course, if it dropped back below, let's say it was a false breakout, I would certainly cut my loss. But that's just an interesting trade thesis I've been monitoring with the dollar-yen, and it just appears that, well, typically the most important, most vibrant moves occur when there's a consolidation pattern that lasts for quite some time. And what happens is traders lose interest in that market. They look at a market that is moving, and they stop looking at the market that's consolidating. Yet they really should be looking at the market that's consolidating, because once it breaks out, that's when the big moves occur. And 1 second, I believe, hey, Jody, I think there's another screen that's being displayed. I don't know.
Oh, that's what is going on here. Okay. Okay, I'll fix that.
No worries. I didn't know if it was something I did. So if any of you folks read Zero Hedge, it's a popular finance and trading blog, which I do tend to read. I think they make many good points. I don't agree with anything any one particular pundit says, hook, line, and sinker, but I like to read from many different information sources. And a few months ago, they had an article that was just basically discussing this extreme bearish case for the yen and also for Japanese government bonds. And I know many people have been trying to short Japanese government bonds for years, and yet they keep on going up, 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 and their interest rates keep on dropping. And so this trade has been called the Widowmaker, because so many people have been attempting to short in advance of the ultimate bond crash in Japan. And I'm sure at some point it will happen, but it really is defying traders. But the yen itself has been weakening, and that's been a better trade. So that's why, another reason why I am interested in this thesis. All right, let me look at some other markets.
Yeah, Jesse, just show your screen again, okay?
Okay. And I'm sure Jody has a take on the dollar yen with her her wonderful Elliott wave analysis. I would love to hear your opinion on that at some point. This dollar yen consolidation that's been occurring over the weekly time frame. All right, let me see how I can share again. 1 second. Let me just put my thinking cap on. Okay. Let me see. Okay, all right. I found it. There we go. All right, so let me look at some other markets right now to show you what I'm looking at. Here's the Australian dollar. So I was showing this to the people in our cyber group chat room in our daily updates. I was showing that the Australian dollar versus US dollar was trading in this range, almost perfect range, between 0.79 and 0.755. So because of the rebound in the past few days or past few weeks of iron ore prices, and also because of the pullback of the U.S. dollar, the Australian dollar finally actually broke right above there, right above 0.79. So now I'm watching to see how this develops. And I just want to show you what smart money is doing in the Australian dollar. But basically, the smart money has been doing the opposite of the trends of the past few months in forex. Basically, they've been betting against further dollar appreciation, and they've been betting on a rebound in non-U.S. currencies. So this is the Australian dollar, and you can see that the commercial hedgers are smart money in green, and they've been quite accurate over the years, actually have quite a long, they've pared it back a little bit, but they're still quite long on the Australian dollar. So it just shows they've been expecting some sort of a rebound in the Australian dollar. So this appears to be it, where you can see this rebound. So I just want to see if 0.79 will hold as a support level. Let's look at the British pound. Same thing here. And whenever you have the U.S. dollar pull back, you're going to have a rebound in non-U.S. currencies. I mean, it's pretty obvious just because they're priced in the dollar, but they also have a mind of their own as well, and that's why I like to look at all the different charts, all the different key levels. So I was showing 1.5 to the U.S. dollar as a major support level, as a major resistance level last month, and then once it broke above there, that was the bullish confirmation. But as I keep on saying, I still want to see if the U.S. dollar index is going to be able to break that support level. And I'm actually going to show you an interesting chart that one of my Twitter followers published today, and I retweeted it. I think it's worth for everyone to watch it. You can see right over here, it was saying the U.S. dollar index is at the most important level. And you can see it's a confluence between that support and that rising up trend line. So I'm just gonna type that. I'm gonna put that into the chat bar if you folks are interested in looking at that on your own, so you can follow it on your own. All right, let me see any other markets. Let's take a look at gold really quickly, just because it's another commodity that trades very closely with. Oh, I'm sorry, I posted a. I have to post. I don't know if I can post. Jody, when you actually I have it right over here. Here's that link.
Yeah, you
okay,
did
I
it.
have it. I posted it to you by accident. If you want to just take a look at that chart, that's what I'm watching as well. So I'm just watching gold right now, and gold trades very closely, of course, in an inverse manner with the U.S. dollar index. So gold has been pretty much in a trading range for the past few weeks. This could be a pennant or a flag type of pattern. It bounced right off that 1150 support level. It's really a zone between 1150 and 1140. So it just bounced right off there because of dollar weakness, and now it's in a range. So if there's further breakdown in the U.S. dollar index, I wouldn't be surprised to see gold break right above this 1220 resistance level and then try to rally back up to its old highs. On the other hand, if there's a bounce in the U.S. dollar index where it rebounds back to its prior highs, then I wouldn't be surprised to see gold try to retest these lows right around 1150, 1140. So, and I'd love to hear Jody's thoughts on the dollar yen pattern, if that looks like a bullish pattern, or I'm a
Do you
big
want me to
fan
tell you right now?
If you want, only if you
sure.
if it's convenient, I'd love to hear your take.
Yeah, sure. Well, we see the dollar yen as a wave 4 consolidation. So in LE wave analysis, we have 5 waves, 1, 2, 3, 4, 5. And this looks like it's definitely a wave 4 consolidation. So we're waiting for a breakout higher. And we're initially targeting about 130, but possibly 140.
Interesting. Thank you. It'd be interesting to see if that wave 5 extends. I know wave 5s and commodities tend to extend more so than in other markets, but that's very interesting. Thank you. All right. So, and I'd actually like to invite you. We have a free event that's actually occurring on Saturday that Cyber Trading University is putting on. It's called it's an expo. I'm just going to give you guys the link right now. There we go. I'm just going to open up that expo. It's a cyber expo with 5 presenters, well-known presenters in the industry, including Steve Bigelow of Candlestick Forum, Vince Vora of Trading Winds, Fausto Puglisi, the CEO of Cyber Trading University, Todd Gordon, he's going to be teaching a lot about Fibonacci, and John Hutchinson of Traders Reserve. So definitely invite you to come in, free event, definitely learn something. And also, I do coaching at Cyber Trading University, where basically I teach everything from forex, futures, options, swing, market analysis, etc. So shoot me an email, jesse@C2Trading, if you'd like to learn more about that, or ask me questions about today's presentation or my views on the market. I love to chat about markets, but doing a lot of coaching where I can guide you using a lot of proprietary methods that I have that I use to make big public market calls and analyses. So shoot me an email if you're interested. And thank you so much for having me, Jody. Looking forward to doing future events with you.
Thank you very much, Jesse. That was very enlightening, just terrific. Do you have time to take a few questions if there are any?
Sure. Go ahead.
All right. If you have any questions, please put them in. There's one. Jeff is asking, how about silver? And Lawrence is asking, he's not asking, he's making a statement, gold looks like a head and shoulders forming.
Okay, yeah, let's take a look. Actually, I was looking at that earlier. Gold's head and shoulders. I see what you're saying where 1180 could be a support level, could be the neckline. But head and shoulders are typically known once they're confirmed by a breakdown. So we don't know right now if that's going to be a head and shoulders or if it could actually be some sort of a pennant or a flag. Let's say if it were to break above 1220 and keep going, then it would no longer look like a head and shoulders. It would be a flag or another type of continuation pattern. But sure, if it breaks below 1180, and of course, in my case, I would like to see the U.S. dollar index rally right off those supports for further confirmation. If, let's say, if I was interested in this in bearish thesis in gold. So just watch 1180 and 1220 as those levels. Let's look at silver now. Silver tends to be very erratic. It's a market that moves very quickly. I know it's correlated with gold, but I was watching on silver. I'm showing you on weekly just because it shows me a little bit of a better, longer-term picture. I was watching $18.50 to around $19 per ounce as an important overhead resistance. You can see that was the lows for much of 2013 and 2014. It broke right underneath there right around September 2014. So it's right now there's major resistance overhead. As far as support, I'm looking at the key psychological level of $15 per ounce. It's a major round number. It also looks like 1550s. As I said, support resistance levels are actually, they tend to be zones rather than a single number. So you can see it's pretty much wedged between this range between $19 and $15. So when one of those is finally broken, that'll most likely be the confirmation that there's going to be another move. But you can see it's been consolidating not only since October, but all the way back almost 2 years, back spring of 2013. So just waiting for confirmation. And I'm also seeing a similar consolidation in gold that's been forming for the last 2 years. I'd love to hear Jody's take on this too from an Elliott Wave perspective. But I've been watching on gold, I'm showing you on monthly, this pattern. I don't know if this is a pennant or a wedge. It needs to be confirmed by a solid breakout or breakdown. But I find this very interesting because I want to know if this is a continuation pattern, because the prior trend was down, and we're eventually going into an environment where the Fed is looking to tighten its monetary policy, looking to raise rates. So that's not typically an environment that's bullish for precious metals, but of course I trade with the trend, so I want to get that confirmation. If it breaks to the upside, then I would have a bullish bias. If it breaks to the downside, I have a bearish bias. But I think this is worth watching, whatever this formation is right here, because if there is a convincing breakdown below 1150, 1140 or so, and there's a further rally in the US dollar, let's say, I wouldn't be surprised to see gold drop down to maybe 1,000 or even lower, especially if the US stock market continues to rally and you get unemployment numbers continue to drop, and it's very possible that that could create a situation where investors may want to jettison gold because it's seen as a safe haven asset, and if the stock market continue to rally, and basically could cause gold to fall even further out of favor. But I'm not making any predictions. I'm just waiting for confirmation either way. But I would love to see what type of count this has from an Elliott wave perspective. Lawrence asks, do you wait for the candle to actually close below the support resistance level to give confirmation of the break? Is one candle enough for it to be considered confirmation? If not, how many closed candles give confirmation that support resistance is broken or confirmed? That's a very good question. That's usually a gray area very often with trading, to know exactly what is considered to be confirmation. If you're very conservative, you'd wait for a solid close on the daily, where you have a strong bullish or bearish candle, vibrant candle that's very tall, or if you use bar charts, obviously a bar. But then when that happens, the market has oftentimes moved so much that now you're getting in almost late and you're almost chasing the market. So that's where it requires a little bit of finesse. So sometimes, depending on how aggressive you go, maybe you could consider putting in half or a portion of the total trade that you'd like to place. Like, let's say if you see intraday, it looks like it's breaking out, maybe you could put in 1/3 or 1/2, and then put in the other half maybe in the next bar or the next day once there's a solid close. That's one way of going about it. So I don't think there is one single correct answer. Some of it's just more a little bit of an art more than a science with that. On weekly, I like to look at the longer term weekly and monthly charts, because I find that there's a higher signal to noise ratio, because there's a lot less randomness in weekly data compared to, let's say, intraday data or even daily data. It just tends to show me the bigger picture. So when you see a solid breakout on weekly, that tends to give, or a breakdown that tends to give a better signal in general than, let's say, if you saw a breakout on the 5-minute chart or a 1-hour chart. And plus, there's a lot lower of a chance of HFT shenanigans that occurs at certain key levels on intraday, where you have algos that are constantly head faking at important levels. Whereas if you see a solid breakout or close on weekly, it's a lot less likely than a few algos can actually move a big market like a currency pair on weekly. So that's why I tend to like to be aware of what's going on weekly and then narrow down on daily and shorter time frames. I mentioned the smart money. Who are they and how do we trade in tandem with them? That is a good question. And I'll give you maybe next time I come around, I'll do another presentation on that, but I'll show you in general. Let me just pull up the charts again. So I'm showing you, when I say smart money, I'm referring to the smart money in currency futures that trade in the U.S. It's not on cash forex. It's actually on currency futures. And the smart money that I refer to and the dumb money comes from the Commitment of Traders report that the CFTC, or Commodities Futures Trading Commission, publishes every week. And you can actually find it by going on finviz.com. I'm going to give you the link right now. It's a free site. I have no affiliation with them, but I find it very useful. And you can look at other futures and other currencies and look at the positioning of the smart money right underneath every market. And you'll notice smart money or commercial hedgers are in green, and the large traders with the dumb money are in red. There are also small traders, but they don't have significant positioning in the market, so I disregard that line, the blue line there. I just look at the large traders and the commercial hedgers. So I try to do the opposite of the large traders and to try to trade on basically like a commercial hedger. And commercial hedgers are not speculators. They're not hedge funds. They're actually institutions that are using currency futures to hedge their exposure to currencies, whether they're importers or exporters or maybe large commercial banks that have exposure to the global forex market. And what they do is they use the forex or currency futures market as a form of insurance. And they tend to be the most accurate, whereas the large traders in red are trend-following funds. It's basically managed money or CTAs, commodities trading advisors, that they trade with the trend. They tend to have a technical trend-following trading style, almost similar to, I don't know if you're familiar with turtle traders, which I believe there's a lot of truth to it, but what happens is when all these trend followers gather on one side of the boat, that's when it tends to tip over. So that's why I look for times where these large traders hit extreme levels, and that's when the market's likely to flip against them. I'm going to show you another example. Here's oil, and this is one of the reasons why I warned that there was likely to be an oil bust. I warned about this on Forbes.com back in June 2014, pretty much right here near the top, or near the peak of that move. And one of the reasons why was because I saw the extreme positioning of both the large traders and the commercial hedgers. And you'll notice in the red that the large traders of dumb money were the most bullish immediately before oil plunged. And that's exactly when commercial hedgers were the most bearish. So I find that very notable, and it's very useful for different markets that you watch. It alone is not a timing signal, but what it does is it tells you when the market's likely to experience some sort of a reversal, or when certain trades become crowded trades, and so on and so forth. But if you want to discuss this further, I have many other techniques and methods. Just shoot me an email, Jesse@CTU Trading, and I'll answer one more question, because that is a good question from Lawrence. Let's see, because I was watching the same thing. Let me see if I have my oil chart up. There we go. So you were asking if West Texas Intermediate crude oil formed a double bottom. And that's something I was watching or questioning when we were in this consolidation range, because it was impossible to tell whether this was going to be a consolidation before another plunge. You can see there's a false breakdown here. It was a bear trap right over here. Or if it was going to form a double bottom. So it looks like in hindsight, once it broke above that resistance level, that yes, it's formed an early stage double bottom. But I want to see if there's going to be a follow-through. I want to see if that $54 support level is going to hold, because if it for whatever reason fell back below that support, then it negates that breakout signal. And next, I want to see how this little formation, whether it's a pennant or another similar continuation pattern, I want to see how this resolves. If tomorrow, let's say, there's going to be another push to the upside, and if the U.S. dollar index is going to break down. If so, then I wouldn't be surprised to see, you could see oil rise. This was about a $10 trading range, so we could see maybe oil head back into the 60s. There are certain ways of determining measured moves. One of the ways is you can actually take the distance of a trading range, like let's say what we saw over here. You can see it was about a $10 trading range, and then you can project that upwards from the breakout point. And sometimes it'll give you an indication of how far it can rally. But I think so much of this oil rally depends on how the U.S. dollar index acts, how the U.S. dollar itself acts, and that goes back to what I was saying about that inverse relationship between commodities and the U.S. dollar. And that's why I watch everything for confirmation, because if you're just looking at oil, you don't have the other form of confirmation from the dollar and other markets. So, all right, folks, I'm sure we could do many more of these webinars in the future. And thank you so much for having me, Jody, as usual. And have a wonderful evening, folks. Take care.
Thank you very much. Bye, everyone. Thanks, Jesse.